Have you ever wondered why money, a mere piece of paper or a digital entry, holds value? For centuries, societies grappled with this fundamental question, seeking an unshakable foundation for their economies. Today, we delve into a pivotal answer from history, the gold standard. What was this system, and why did it become the bedrock of global finance for so long? Before delving into the gold standard, let's consider the very essence of money. For any currency to function, it must be trusted. Early forms of exchange, like barter, were inefficient, leading to the adoption of commodity money, items like salt or shells with intrinsic value. As economies grew, the need for a more portable and divisible medium of exchange became paramount. Precious metals, particularly gold and silver, emerged as ideal candidates due to their scarcity, durability, and universal appeal. They offered a tangible store of value. Paper currency and banknotes eventually gained traction, promising convenience over carrying heavy coins. However, this introduced a new challenge. How could people be sure these paper promises were truly valuable? The gold standard emerged as a powerful solution, directly linking paper money to a physical asset that commanded inherent trust. At its core, the gold standard was a monetary system where a country's currency was directly convertible into a fixed, predetermined quantity of gold. This meant that the central bank or treasury stood ready to exchange paper money for gold, and vice versa, at a set price. For example, if 1 ounce of gold was valued at $20.67, then every dollar bill represented a claim on a specific fraction of that gold. This convertibility was the bedrock of the system, ensuring that the paper currency held its value. It wasn't just a promise, it was a guarantee. This system created a direct and transparent link between the amount of currency in circulation and the nation's gold reserves. Governments could not simply print unlimited money without having the corresponding gold to back it up. This constraint was a defining feature, intended to instill discipline. The gold standard existed primarily to provide stability, predictability, and trust in an era of burgeoning global commerce. It was a deliberate choice to impose monetary discipline, limiting the ability of governments to inflate their currency. By tying money to gold, governments inherently restricted the growth of the money supply. This mechanism was designed to prevent excessive inflation, thereby preserving the long-term purchasing power of the currency. For individuals and businesses, this meant greater certainty about future prices. Furthermore, for international trade, the gold standard offered an elegant solution to exchange rate volatility. Since each currency was defined in terms of gold, their exchange rates against each other were also fixed. This simplified cross-border transactions and reduced financial risk for merchants and investors. The late 19th and early 20th centuries witnessed the zenith of the gold standard, often referred to as the classical gold standard period. Great Britain formally adopted it in 1821, followed by most major industrial nations by the 1870s. This era, from roughly 1870 to 1914, was characterized by expanding global trade, relatively stable exchange rates, and significant international capital flows. The system provided a common monetary framework that facilitated economic integration across continents. Economists often point to the price-specie flow mechanism as a key feature of this period. If a country imported more than it exported, gold would flow out to pay for the deficit. This outflow would reduce the domestic money supply, leading to lower prices, making its exports more competitive and eventually correcting the trade imbalance. While offering stability, the gold standard also imposed significant limitations on economic policy. Because the money supply was rigidly tied to gold reserves, governments had limited flexibility to respond to domestic economic shocks. During recessions or financial crises, a central bank could not easily increase the money supply to stimulate the economy or provide liquidity to struggling banks. This rigidity could exacerbate downturns, leading to prolonged periods of unemployment and hardship. Moreover, the system meant that a country's economic fate was, to some extent, tied to its gold discoveries or its ability to attract gold through trade. A sudden influx or outflow of gold could have profound, often uncontrollable, effects on the domestic economy, regardless of internal conditions. The gold standard, despite its strengths, eventually buckled under immense pressure, particularly during times of war and economic upheaval. The First World War proved to be a critical turning point. Financing the massive costs of war often required governments to print more money than their gold reserves could support. Countries temporarily abandoned convertibility to fund their war efforts, leading to inflation and disrupting the fixed exchange rate system. The interwar period saw attempts to restore the gold standard, but these efforts were fragile. The Great Depression delivered the final blow. As economies collapsed, the rigid constraints of the gold standard prevented governments from implementing expansionary monetary policies needed to combat deflation and unemployment. Nations began to devalue their currencies or abandon gold convertibility altogether to regain control over their monetary policy. The gold standard was neither a utopian system nor an abject failure. It successfully provided a framework for monetary discipline and international financial stability for a significant period, fostering global trade and investment. However, its inherent rigidity proved unsustainable in the face of modern economic challenges, particularly the demands of managing severe economic downturns and financing large-scale conflicts. Understanding both its strengths and weaknesses is crucial for a nuanced appreciation of its historical role and its lessons for contemporary monetary policy. It reflected a deep-seated desire for limits and confidence in currency, a desire that continues to shape economic debates today. The gold standard existed to anchor money to something tangible and trusted, reflecting a historical quest for stability and confidence in financial systems. Its legacy continues to inform discussions about monetary policy, inflation, and the role of central banks. While no longer in use, its story offers invaluable insights into the complex relationship between money, trust, and governance. In our next discussion, we will explore the fascinating reasons why countries ultimately abandoned the gold standard and what new monetary systems emerged in its wake. Asterisk. Disclaimer. This content is for educational purposes only and is not financial or investment advice. It aims to provide historical and economic context. Asterisk. Please like this video if you have enjoyed this deep dive into the gold standard. Every like we receive inspires us to create helpful and informative content. Thank you once again for watching. We hope you have a blessed day, and we encourage you to share your thoughts and questions in the comments below. Let's continue this important conversation about economic history.